All right. Hey, Dan Passarelli here. How are you feeling today? I hope you're feeling great. I'm feeling great. So, today we are going to talk about protecting stocks in down markets using options. Now, before we get started, I need to point out options are not for everyone. Please read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're talking about here today is generalized information, not specific to your personal situation. All right. Hey, we've got some old friends here today. Who we got here today? Oh my gosh, we got let's see, we've got a lot of folks here. We've got James and got some note takers here. Who are the note takers here? Shane. All right. We've got some old friends here, but we've got some new names here that maybe you're not familiar with who I am. And that's okay, because we're going to be good friends by the time we're done here today. Allow me to introduce myself. My name is Dan Passarelli, and I am an author of two of the most popular option trading books. It's Trading Option Greeks and The Market Taker's Edge. And I am a trader. I traded for years down on the floor of the Chicago Board Options Exchange, traded off the floor, traded on the Chicago Board of Trade CME group, and now I trade in a retail trading account just like you. And I am the founder of Market Taker Mentoring, which is the global leader in option trader education. And I collaborate with a lot of the good players in the options industry, some of the best options friendly brokers here, like Firstrade, and even many of the exchanges. Chicago Board Options Exchange, traded on the floor, worked actually for the exchange. Basically, every options exchange really in the world in some capacity I worked with on some level. And I'm a family man. Those of you who are already market taker student traders are probably familiar with my wife, Kathleen, who runs operations here with Market Taker. And I have my two adult children. And outside of trading, I do other things for fun. I am a runner, a foodie, traveler, been kind of all over the world with either my family or as a result of my work here with Market Taker Mentoring. And I'm a music person too. Now, the things we're going to talk about here today are related to my podcast. That's right. I have a podcast and it's free. Who listens to podcasts? Hey, hit that questions box. Give me a yes if you listen to podcasts, or a no if you don't listen to podcasts. That's okay. Not everybody listens to podcasts. Actually, I read a study recently, about 50%, 50% of everyone in the United States has listened to a podcast within the last year. So I think there's more of you than James here. I'm just saying. James, have you checked out my podcast, Wealth Building with Options, yet? No, you should check it out. Would you check it out for me? And let me know what you think. Leave a comment. So that podcast covers covered calls and cash secured puts. It's really great for wheel investors of all experience levels. We talk about adjustments, mindset, strike selection, analysis, and more. There are new episodes weekly. The latest one just dropped today. James, thank you for checking it out. I appreciate it. Send me the link you're trying to go to, James. And the podcast is free. you can access. Huh. Well, let me run that one up the flagpole there, James. I'll send that to my people right now, because if there's a problem, gotta take care of it. Thank you for alerting me. We'll just send that over to powers that be. All right. Appreciate that, James. Now, if you can access the podcast by going to marketicket.com/applepod, marketicket.com/Spotify, or just go to Apple, Spotify, or anything you listen to podcasts on, including YouTube, and you can find the podcast. Just search Wealth Building with Options. All right. So, protecting your holdings. Options can be used to help protect long-term holdings like stocks or ETFs, even futures. But the strategy, it really needs to be structured correctly. Far too many people read, oh, hey, if I buy puts, I'm protected. And they do, but they do it wrong, and they end up losing money in the long run. They think they're doing it right, but they end up underperforming the market, and sometimes really not intuitive why. At the end of the year, they say, geez, the market was up 10% and I'm only up 5%. I can't figure out why. I thought I did everything right. So there's some really important things that you have to take into account. Now, the ways that we can protect your stocks in down markets is protected puts and collars. And I mean, actually, there's a lot of other ways too. Covered calls actually do it. Arguably, cash secured puts can even do it, which at first seems counterintuitive, but it's true. So we're going to focus today on protected puts and collars. And if we have time, we'll get into some other things. Sound great? All right, let's do it. So, protective puts are when you own a stock and in order to protect it, you buy an out of the money put. Now, when you buy an option, that's called being long the option. Now, I want to point out a really subtle difference here. There are two very similar strategies. One is called protective puts, and one is called married puts. You ever wonder what the difference is on these things? Well, a married put is when I buy a stock and I buy a put at the same time as part of one trade. A protective put is when I own a stock and then at some point in the future, I buy a put to protect it. And I do that to limit risk, but it can be a big cost. Now I want to go back to this married put for a second. Who here has seen the Firstrade webinar that I did on synthetics? Did you see that one? That was, oh gosh, that was a while ago. You haven't? Well, if you haven't seen that one, you can check it out. Firstrade, they take really, really great care of their people, their audience, you. So you can always go back and review all of my webinars for Firstrade just by going to the Firstrade YouTube channel. And remember, there's only one T in Firstrade. But a married put, when I buy stock and I buy puts at the same time, well, instead of doing that, I can do synthetically the exact same thing. Does anyone know what the exact same thing synthetically is compared with buying the stock and buying the put at the same time? What is the synthetic equivalent? Are you in the wrong place? No, sir or ma'am. I don't know. It says anonymous. No, sir or ma'am. You are not in the wrong place. You are in just the right place. This is a more basic level presentation, but for those of you who have seen my Firstrade webinars in the past, you know that um, I never keep with just the basics. I always sprinkle in some advanced things for everybody so that everybody in attendance learns something. So the answer is no, you're not in the wrong place. You are in the right place. Okay. So either way, hey, nobody answered me. If I buy stock and I buy put at the same time, what is that synthetically equal to? This is one of the advanced things that I sprinkle in here. It's not a basic thing. Nobody knows? Oh my goodness, I can't even believe it. Um, it is buying a call. So I never really understood why somebody would buy a married put because you're paying two commissions. You're making two trades and you're tying up way more capital than you need to. And it just doesn't make sense when you can just buy a call and it's the same position. So for me, whenever I buy puts against a stock that I have, I buy it only when I feel I need it because puts are expensive. Yeah, puts are really expensive. And we'll talk a lot about that here. In fact, before I even do that, let me just show you an example of just how expensive puts can be. Oops. Firstrade has great security. And so I have to check my email to make sure that it's me and type in the verification code. So let's see here. Verification code 8 starts with an 8, but I better not tell you the rest, otherwise you're going to hack my account. All right. All right. So let's just look at what stock should we look at? Anybody want to look at a particular stock? MSTX. MSTX, James. That's a crazy one, man. I typed it into the wrong place. Sorry about that. Hold on a second. I want to see a chart of this thing before anything. Where's that chart? Oh, gosh. My head is not on straight today, folks. Do you ever one of those days where, like, I don't know, you just can't figure out what the heck is going wrong? So, what the heck is this? I'm not familiar with this ETF at all. Is, this is 2 times long MSTR stock? Is that what this is? Why don't you just buy twice as many shares? Is that what that is? MicroStrategy? All right. Well, if you're going to keep it a secret, James, I'm just asking a question over here. um, okay. So this is a crazy one. Oh, it's tied to Bitcoin. Well, yeah. I mean, MicroStrategy is. So this is 2 times MSTR here. You know what I always like to do, friends? This is what I like to do. I like to bring this over here and I say, what is MSTX ETF? Because if you're going to trade something, you better freaking know what it is. Define seeks to leverage results of 2 times or 200% the daily percentage change of MicroStrategy. Man, I'll tell you, I personally feel like most of the 2 times ETFs are just for people who don't understand options. Because, like, if you want leverage, you can do that with options. But hey, whatever. You know the best way to protect yourself in this scenario? Oh, this pays a high dividend, Shane? Seriously? Huh. So that one, I always like to trust but verify. Not MSTY. Don't you hate when it tries to correct you? Not MSTY. No, not MicroStrategy. These guys punking me over here or what? Did I type it in wrong? No, I didn't mean that. That's weird. So then I go MSTX stock or ETF. Wow. News, news, news. Oh, well, we can look at it later. I'll take your word for it. MSTY paid, I don't know what that stock is. It pays that. It pays, MSTY pays 121% yield. Jeez Louise over here. So, all right, I'll research this later. Research takes time and research, nobody want, no, you're a bored person if you're logging into a webinar to watch somebody do research. I mean, you're a bored person if you're doing that. Okay, so answered live, done, answered live, done, cancel, answered live, done, answered live, done. Okay. So you got this here. How do you protect this? Now, one thing I like to do is let's just make this a little bit smaller of a thing so that it takes up more real estate on the screen here. So we've got some support down here. We're kind of at resistance. And it bounced down from resistance, although today we're having a bit of an up day. But as you can see, I mean, this puppy was massively higher, but that wasn't too long ago. That was just 6 months ago. It was massively, massively higher. But I think that was after Trump got elected and everybody thought that crypto was going to go to the moon, probably, right? Is that probably what that big move was from? I bet. Or maybe it was a short squeeze. I don't know. But we want to protect this. So, okay, so here's the thing, folks. We're going to go to options and we're going to go to MSTX. We're going to go to get option chain. Now, we always like liquidity, and these are actually pretty liquid. The first thing we want to do is decide how long do we want to protect this? Because here's the thing, like, let's say, okay, I have this, I'm bullish crypto, for example. Okay. I'm not saying I am or I'm not, just a hypothetical example. And yeah, I think I'll probably be long it for the rest of the year. So I want to protect it all the way out to December. So this is a $45 stock. If I were to buy the 45 strike calls, I'd pay, or puts, I would pay $20 a share. So now here's the thing, friends, okay? Uh, 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 Whatever price, hold on a second. Whatever price you pay for the put, that's a cost. So, and I'm not using the canned examples here. I want to give you like the real experience here today. So if I like think of a protective put as an insurance policy, okay? If I buy an insurance policy on my car, which I probably should, oh, hey, thanks, Sergey. Yeah, I know of a lot of those. Uh, I know that there's a lot of those. I'm going to check it out later. So think of you buy insurance on your car. Maybe you have a $45,000 car, okay? Which is, kind of a nice car. I mean, it's not like a Lamborghini, but it's not like a piece of junk by any stretch of the imagination. I mean, it's a better than average car, right? Okay, so maybe you think that about this stock too. $45 a share. Maybe you own 1,000 shares. Same thing, right? You got this $45,000 asset that you want to protect for a whole year. Now, how much do you pay in car insurance? What is your, say you have a $45,000 car, okay? And if you do, or even if it's close, did I make the screen bigger? I don't know how to make, yeah, okay, I can do that. I can do that. Hold on a second. Oops. Hold on a second here. Oops. That's the wrong way. How's that? You didn't think I could do it, did you? You did not think I could do it. I can do it. I can make the screen bigger. You're welcome, Jason. Yeah, me too. This is why I wear these glasses, because I can't see the little stuff either. Sometimes like I raise the font size on my phone like just a little bit because I don't want to make it too easy for my eyes because I want to train them to try and look. But like when a person who is like younger and has better eyesight, when they have it on normal or they have it on like small so they can fit extra stuff on their screen, I'm like, how do people see their phone like that? But then like I have this one friend who puts it on like the extra large and like you can fit half a word on the screen. It's like, okay, that might be a little overkill. Get some glasses. Okay, back to our car. Who has a car somewhere between like 35 and $65,000? Probably most people, right? Not everybody. You just need that car to get you to the train station, just get you around town. You want to be, smart and not invest in some decaying asset that decays as soon as you drive it off the lot. Maybe you are smart about it and buy a less expensive car, but come on, this is participation here. Who owns a car, somewhere around 45 grand, give or take? Okay, Larry, James, hey, welcome, Larry. What do you pay for a year for car insurance? Just round it. And if somebody asked me this question, I would say, I don't know. I got to ask my wife. Okay. James says $2,400. So 45,000. And Larry says 3,600. Larry is a terrible driver. He's had 3 accidents in the last year. He crashed into, no, I'm just kidding. I don't know. I'm just trying to be funny. Okay, so let's round that to 3 grand. That's like smack dab in the middle there, right? 3 grand. Toyota Camry, sensible car. Toyotas, I mean, they make good cars, man. They make really good cars, don't they? Okay, so 3 grand. So $45,000 car, pay $3,000 in insurance. Oh, an Infinity? Well, yeah, it costs more to, Infinities are going to cost more, so probably the insurance costs more, right? So 3 grand to hedge, to protect a $45,000 car. Okay. Okay. So what does that come out to? And first of all, is that a reasonable rate? Is that a reasonable rate? Are we happy with that? I mean, obviously we'd want it to be less, right? But, it is kind of expensive. Yeah. But you got to pay it anyway. You're not going to not pay it. Although some states, I think a lot of states, you have to pay it. So 3,000 divided by 45,000, you're paying 6.7 cents a year. And it's kind of a big cost, isn't it? I mean, how many years does it take? So if we took 45,000 divided by 0.06666666. Oh wait, I did that wrong. Well, easier way, 45,000 divided by 3,000. I mean, in 15 years, you pay the value of your car. You better crash that sucker in 15 years. Not really, right? You hope you don't crash the car. But you're going to pay $45,000 in 15 years in car insurance. Yeah, try to replace without it, right? And insurance is weird too, right? Has anybody had a car accident within the last couple of years? I have kids in their 20s. I can count about 4 that we've had in the last 2 years. Yeah, my kids are terrible drivers. They're not home right now, so they can't hear me. But once, yeah, no kidding. But there were 2 times where we got for our car, we were like, holy cow, thank you. That's way more than it's worth. And then there was one time where we're like, what the heck? We can't buy a replacement vehicle for this amount. So we actually kind of benefited twice and got screwed once, but I don't really know how it all works. So anyway, it's 6.7%. I don't know. The consensus is, yeah, it's expensive. Yeah, it's fair. We're somewhere between there. Yeah, I know. Yeah, overall, I did good. I was, I'd kind of like to benefit all of the times, but overall, I did good. But we're looking at this, and this is like 45%. Let's see, if I buy these puts, 19.7 divided by 45, I'm paying about 44% of the price of the stock. The stock would have to go up by 44% just to break even. It would have to go up by $19.70 just to break even. If it stays where it is, I lose money. If it goes down 10 bucks, I lose money. So I have to decide, how much do I want to protect this? Or what I really need to do is say, is it reasonable that in a year this stock can get down below 25? Because I'm paying almost 20 bucks for the put. I'm going to flush down the toilet as an insurance premium, 20 bucks a share. If I don't think that there's a reasonable chance that if things go wrong, like obviously, if I own the stock and I'm buying a put, I am bullish. Okay. This is not a bearish trade because you're buying a put. You own the stock. You get a chart that looks something like this. Protected to the downside, but you have all the upside exposure. So if I don't think the stock can get down below 25 bucks, I'm doing a terrible disservice to myself buying this put. And if I don't think that the stock can get over 65 bucks, I'm doing a terrible disservice to myself buying this put. This put is absurdly expensive. Yeah, Larry says sell it. And I do a lot of stuff on cash secured puts. Larry, do you listen to podcasts? Have you checked out my podcast yet? Wealth Building with Options. Oh, you have? Oh, thanks, man. I appreciate that. So, another way to do this then is I could sell this put, sell it at 19 bucks. If I sell it at 19 bucks, oh, I knew about that, Larry. Thanks, man. Appreciate it. If I sell it at 19 bucks, what price would I actually take possession of the stock if I get assigned? Because if the stock is below 45 at December expiration, I would get assigned. If the stock is below 45 and I get assigned, I would buy the stock at $45 a share, but I also get to keep that $19 a share. Let's just round it to 20, make the numbers easy. So I'm basically getting long the stock at 25 bucks a share. I'm technically 26. I guess I don't have to round. So if I'm thinking about buying this ETF today, I'd kind of like to buy it on a dip. It seems like crypto's pretty bullish, but hey, making 47% on anything is a pretty freaking good investment. I could sell this put at 19 bucks. So my effective purchase price, if I even get assigned and buy it, would be 26 bucks. Way more conservative, arguably $19 of protection. And I do limit my upside profit potential to 19 bucks, but that's 47% in, well, actually less than a year. Annualized, it's going to be over 50%. I mean, this is kind of a good trade unless it's down below 25, right? And so we want to take a little look-see-poo at that again. Let me shrink this just a smidge to pull up the chart. No, wait. Yeah, right there, right? Oh, my head is like not on straight today. Merry Christmas. Yeah. Yeah, I know, Larry, right? So, like, get out of here. Get out of here, you little note. I mean, this thing did get down to like 21. So, there's that. And that was just a month ago. Can we do better than that? Well, I'm glad you asked that question. Let's take a look. We've got to go. Oh, there's no leaps. Oh, darn it. This is the longest out we can get. What I like to do in these situations is look at Greeks and analytical. Look at the IV. I mean, the IV that's a pretty high IV. I mean, it's all kind of relative, You'd want to do a complete analysis by pulling up some sort of volatility chart, find a free service online for that. But that's why it's so high. Let's see here. We got weeklies. June 20th would be the regular expiration. So then we've got, June 27th is still a weekly. Yeah, so we won't get a longer term expiration for a few weeks. So yeah, this would be our best bet. So, I mean, it's weird, but it is a way to protect yourself by selling puts sometimes instead of buying the stock. But in less expensive situations, it might make more sense to buy the put. So let's look at a pretty good example for that. So this is the one that I had in the presentation here. So I own 100 shares of Spiders that are trading, for example, at 551. Well, I can buy the, whatever expiration, May. I think I had John put this together a couple weeks ago. 541 put. So a little out of the money because, with your car insurance policy, you want to have a deductible, right? Like the first $2,000 of damages on you. Well, that's kind of what the strike selection is like. Spiders are at 551, but I'll take the first $10 worth of risk. If it goes below there, then the insurance policy kicks in. I can exercise that put and sell it at 541. So let's say, I don't know how many days to expiration these had when John took the screenshot, but let's say that's 2 weeks. It's probably about 2 weeks. Well, how many 2-week periods are there in a year? Well, there's 104, right? So what does this look like as a percentage? So 6.89. No, not 104, 26. Sorry, I goofed that up. 6.89 times 26 2-week periods in a year. That's $179 that you'd pay if you just did this every 2 weeks, if this is annualized. $179 divided by 541. I mean, that's 33% of the stock. And you've got to think about it this way. If you want to protect your stocks, you can't always just be buying puts. You've got to really pick your spots. Otherwise, I mean, you just lose too much. Now, if I was only concerned about this 2-week period for some reason, and in order to have so much confidence that only this 2 week period is risky. After that, it should be fine. I don't know about that. To me, that might seem like some crazy logic. Anybody who's been in the market for a long time, I think, would agree with me because there's black swans. We all know that any crazy thing can happen, right? So, yeah. But arguably, we can perceive some periods to be riskier than others. So I pulled this chart up before. This is a chart, well, a P&L diagram of this 2 week period. If we own spiders and they're trading at 551 and we buy the put that expires in 2 weeks at 689, that has a 541 strike, is what we get. Anywhere below 541, we have limited risk. How much is our limited risk? The most we can lose is 1689, which is 3.1%. Oh, yeah. Sure. I can lose 541 or 551 minus 541, my $10 deductible, plus I'm going to lose the 689 divided by 551. So I can lose 3.1%. Oh, 50 days? 50 days. This is not 50 days. This is a couple weeks. John forgot to change this. Best case scenario, I give up 1.25%. That's 6.89 divided by 551. So for 2 week period, I give up 1.25%. If I really have a good reason to believe that I only need insurance for this 2 week period, and I don't know what that reason would be, but truth be told, I have bought protected puts. I have, but I try and do it extremely sparingly. And it's so hard to time it. So hard to time it. And the important thing to remember is this is a bullish position. Isn't it? I mean, do we want to cash in on an insurance policy? Who wants to crash their car because you bought insurance? Anybody want to crash your? I mean, my story about 2 out of 3 times, getting more than my car was worth. Yeah, maybe you do want to crash your car. I don't know. I don't recommend it. I would not advise you to do that because you could get hurt. So don't intentionally crash your car. But, the key implications here are I'm giving up a certain amount. That's the difference between the dotted line and the solid line. But under the strike price, I'm fully protected because I own the right to sell the stock at 541, which, is the difference between the stock price and the strike price. The lower it goes, the better the insurance helps us. So how do I overcome that cost? Well, I can sell a covered call to finance the cost of the stock. And we've already talked about covered calls. So covered calls, say, own 100 shares of spiders. I sell like the May 561 calls at $8.33. So they're just the opposite because I'm collecting money. I actually outperform the stock. With the put, I was paying money, so I underperformed the stock. But here it's just the opposite. If I'm above 561, I reach my maximum profit potential. So like if I'm thinking the stock can really skyrocket or ETF can really skyrocket, I wouldn't want to do a covered call. I bring in a 1.5% premium over it's probably be about 2 weeks too, right? So collars is when I combine the two. So that is long stock with a short call with a long put. So this is limited risk and limited reward. We're basically doing this to hedge our risk. We're doing this to hedge our risk, but pay for the hedge. And there are some times, like apparently this time around, where presuming all John's inputs were accurate, which, John's an excellent trader. He's our head coach. He's great. But you might be able to actually take in a credit. It's usually rare to take in a credit, especially on spiders. But if you can do it at zero cost, great. Even if you pay a little bit, that's great. You just don't want to be paying 1.25% for a couple weeks. It comes out to 33% a year. You don't want to be doing that. So what you end up with is something that looks a little bit more like this. So this can be a debit or a credit, and it's usually a debit. Hold on a second. Let's take a look at what this looks like right now. So the SPY is at 593.41. Let's look just over 2 weeks out for those of you who are watching this live. Oh, actually, maybe maybe John did put that together further ago. Yeah, I probably did. Maybe it was 50 days. I don't know. Let's look. Get rid of that. Get rid of that. Oh, yeah, there's dailies. Yeah. I'm like, oh, that was just okay. Yeah. So 2 weeks out is actually more like, it's 2 weeks from now. I got to pull up the calendar app on my phone here. Hold on a second. 2 weeks out would be June 3rd. So this is not at a perfect strike here. Does June 2nd have dollar strikes? Yeah, let's use June 2nd because they have dollar strikes. What if I sold pull up all? If we're at 593, let's look at 583 puts. Oh gosh. Yeah, I guess that was more than 2 weeks. Oh shit. I'm looking at the wrong ones again. Darn it. So 583. Yeah, John was looking at more than 2 weeks. So 2 more weeks after that, I can do that math. Let's just call it June 13th. So this is about 3.5 weeks. And it's in $5 strikes. So, so if we just go to 580, we can buy these puts at 470, and then we'll go to 605. We can sell these at 455. So we're paying 15 cents. It's basically zero cost. In this case, when there's $5 wide strikes and we're trading at like 593.37, you're not going to get a perfect balance. Like the puts are exactly as far away as the calls, but this is close enough. So we're paying 15 cents. So basically if we were to pull this back up again, above, what was that, 603, I have limited profit. Below 583, I have limited loss. So all I can lose is 10 bucks and 15 cents. All I can make is $9.85. I don't know. I mean, that's only 2%. For those of you who are watching this live, or you can remember what things were like, the last third of May, what is today's date? Today's May 20th of 2025. If you remember what that's like, you want to look at a chart. There was a fair amount of volatility. Last couple of days were a little slower, but I don't know, 2% in 3 weeks. I'd probably want to go out a little farther. But if I go out a little farther and I want to balance it, like the call strike and the put strike are equally far away from the stock price, then I'm allowing myself to lose more. Here I allow myself to lose about a little under 2% because $10 divided by 551 is a little under 10%. If I go out to like 573 and 613, I'm losing more. Or I could stick with the 583 strike on the puts and sell a higher strike on the calls, but then it costs me a little bit more. But hey, that could be okay, right? What if I sell these? Oh, yeah, 605 calls at four. No, wait. What if I buy these 580 puts at 470? So that's, wait, 580 puts is $13 out of the money. So yeah, that's a little over 2% risk. But instead of going just 2% up, what if I sell like the 615 calls? Well, that's $1.80 that I could get for those. That's an extra 10 bucks. So I'm giving myself room for it to run from 593 to 615. That's $21.63, right? So that's like 4%, something like that. But if I'm paying 470 for the puts, 4.7 minus the 1.8 that I'm collecting for the calls, I'm still paying $2.90. But $2.90 is like 65% of what I would otherwise pay. $2.90 divided by 593. That's, oh gosh, that's nothing. That's a 0.5%. Whereas if I was paying 470 divided by 593, that's 0.8%, paying a lot more. So yeah, apparently John actually was using 50 days to expiration. I forgot that he did this a long time ago. So that's basically everything that I have to say about cash secured puts and well, no, there's one more thing I have to say about collars. John's 60-day or 50-day example was kind of a little better. I mean, well, one thing about it is that over 50 days, you got to figure it can move up or down more than 2%. And you're glad about the downside, but you're sad about the upside. Like, you wouldn't be holding this stock if you didn't think it was, or this ETF, if you didn't think it was going up. So collars, while protective puts tend to work better, While protective puts tend to work better on short periods of time because you don't want to pay very much for them, collars tend to work better in longer periods of time. And I'll show you why. Let's say we want to hedge through the dog days of summer back into September is the worst month for stocks. So maybe like August 29th. Well, actually, since September is the worst month of stocks, that's where we really need our hedge. So we want to hedge through the summer, through a good part of the worst month for stocks. It's at 593.37. Is it still at 593.37? Hold on a second. Let's make sure we refresh the stock. Oh my God, I'm such a goof. Keep typing it in the wrong place. My brain is not firing on all cylinders today. Yeah, so it's basically in the same place. Okay, so SPY, we got the range for all. Going to get rid of the May 20. Let's go all the way out till September. It's 101 days to expiration. So with spiders at 593, what's our deductible going to be? What strike are we going to pick? Well, maybe 580. Okay. We don't want to lose more than 13 bucks. 13 bucks is 13 divided by 580, 2.2%. Okay. But we want to give this thing room to run up, right? What about the 610 strike? That would be 10, 18 bucks. So let it run up 18 bucks, down 13. Probably want a little more room, right? How about 615? Let it run up 23 bucks and risk 14. So what did I say? The 580 strike, right? So we pay 14 bucks. And then I said 515. I collect, just round it to 12 bucks. I'm only paying 2 bucks for that. I might even go up to the 620. Sell these at $9.50. I'm only paying $4.50 for protection all the way through. Oops. Oh, I was using the August 29th, but whatever, it's the same. I cut my expenses by a third. That's pretty good, isn't it? Basically, I'm risking 3% because my deductible, my strike price allows it to fall about 2%, and I take in, and I'm paying out a little less than 5 bucks, so a little less than 1% of the value of the shares. But I'm allowing it to run up to, what did I say? 5. Like goof, I clicked on the wrong button there. I think I had it on August 29th. Doesn't really matter. But I was saying, hey, I could let it run up to 615. So that's 15 plus 8, it's 23. 23 divided by 593. Yeah, I mean, that's almost 4% minus the 450 that I pay for the thing, which is less than 1%. I mean, I can make 3% or I can lose 2%. That's not really that bad, is it? I mean, you can't do that if you're just buying puts, but you can do that if you creatively construct a collar. And so, like the moral of the story is you kind of have to tinker with the strikes a little bit. All right. Do we have any, do we have any final questions before we call it a day? Any final questions? All right. Well, thanks for joining me today. Have a great rest of your day. I will see you next time. Trade smart. Bye.